Good morning. Welcome to Core Services and our Core Belief Series, Why It Matters. Today we're going to talk about that dreaded letter that often comes from the CPA with the financial statements, the comments on internal control, and what it means and how you might consider responding to it if you were to receive it. Today, before we get going, we're going to a little bit about Core Services. Core is focused on audits and reviews of condominium and HOAs in Oregon and Washington. And we also offer advisory services for the boards to help them be more effective and efficient in their board oversight capacity. So a little bit about internal controls. So I think it's really important to understand that the auditor and the reviewer, for those that are under review, do not test the internal control for how management functions from day to day. It doesn't matter whether it's an employee that works directly for the board or whether it's an independent management company. We have to establish an understanding of how they do it. We need to be able to document who does what as far as what roles, what positions, but we do not test it. And that's primarily because there's just not enough transactions. And if we did find something that didn't work, we'd be right back where we started, which is we're going to have to assume the controls don't work anyhow. So, we basically say we're going to assume we're going to find something that deviates from the internal control plan, and so we go after and we start looking at the actual documentation. We look to make sure there's an initial. We make sure that things that need to have board approval are in the minutes. We can't rely upon the fact that it's there and management's done it correctly. And I think that's a big misunderstanding because a lot of people, especially managers, feel like we should trust them in how they're doing their work, and our rules just don't allow us to. Either we're going to test the internal controls and find that they work, or we have to assume that those controls are ineffective. And so when we are preparing or doing our field work, one of the things we're obviously doing is creating our documentation trail of who's doing what and why, and does it fit the pattern we understand. And in a lot of cases, when we see something where there's a breakdown, it comes down to these common areas. And a lot of the biggest one we find is a lack of board approval for spending, especially when there's been a budget assigned to it, and the management goes over it for whatever reason. And then, so obviously from there, we would look to the minutes to see if the board had approved that cost overrun, and we can't find it. Then it becomes so how did you get approval? Well, we sent an email around. Okay, but do you understand the rules which says that the board should ratify after, at the next meeting, any email votes? So we need to see that documentation because the board set the budget. Management should not exceed it without the board's approval. Another big area where we see a lot of potential breakdown and the opportunity for financial statements to be misleading is when we have a management change. If the board decides to change management mid-year, totally within their right, but the new manager doesn't bring in the first 2, 3, 5, 11 months worth of transactions. They only want to report the transactions they're responsible for. Well, that means they could be making a decision that could cause bigger problems because they didn't bring in that first part of the year's transactions. And so accounts receivable might be overlooked. Accounts payable might get overlooked. This is bad for the reader of the financial statement. So this is the kind of thing that when we discover it, we need to report it. And obviously, sometimes we find something that it's not just something that can just be what we consider an annoying problem that should be corrected. It's actually a big deal. And so when we are doing this, we obviously have two primary categories of a deficiency. And the one we obviously focus on the most is the material weakness. And a material weakness and a significant deficiency are essentially the same thing. They're both about something going wrong and either the possibility that nobody catches it or that nobody corrects it before it gets into the financial statement. And so that's what we're concerned with, is that financial statement, that year-end product that goes out to the owners and is available for prospective owners. If it has a material error in it, they could make a decision that is detrimental to them because the information was not provided to them correctly. A significant deficiency is obviously is simply less severe. So it might be a accounts receivable where an owner was charged, they moved out, that fee didn't get collected at closing, we're not going to collect the money, and the management company failed to write it off. Again, it's $25. No one's going to lose sleep over that transaction, but nevertheless, it should have been corrected, and wasn't. So that would be a significant deficiency. It doesn't rise to the level of somebody reading it and and potentially making a bad decision. So why does it matter? Well, if you think about it, internal control is really all about providing a system to safeguard the association's assets. Make sure that the cash isn't spent on things that the board didn't either pre-approve through the budget or approve after the fact. After looking at the potential need for that transaction. And it's really all about, from our perspective, presenting an accurate financial statement. If you fail to record the accounts payable, it could seriously impact somebody's decision making. And to us, that would be an inaccurate financial statement if you decided to leave off an accounts payable because you didn't receive the invoice by December 31st and you didn't want to take the time to make a reasonable estimate, or even better, call the vendor and say how much do we owe so I can get this on the books. And when we see that internal control weakness, we're concerned over the fact that a selling owner is maybe making a decision and getting asking for a price that may not be realistic, or even a major opportunity because financial statements are totally inaccurate. It can mislead a buyer. And if they do read it and they do rely upon it and say, okay, I think everything is great, only there's something wrong with it, they may have not made a buying decision. And this happens in the publicly traded sector as well as in the HOA and condo market. When there's a breakdown in the internal controls, it can lead to a misuse of organizational assets. We worked with one. We had to withdraw from the engagement, but we found a community manager actually using his position as the manager to send repair business to his own contractor's business. I mean, where was the internal control to ensure the manager didn't have that ability to set up a company and funnel work to that company, and which may have not been in the best interest of the association? Maybe the board would have made that decision had it been disclosed, but it wasn't disclosed. That's a breakdown of the internal control structure. And what really happens when people finally find out that something is wrong? No one wants to trust one another. There is no trust. There is no feeling of security. We question everybody's loyalty, their ethics. So a good, solid internal control structure simply allows people to go about their lives and feel confident that things are working the way they're supposed to. Again, I hope this has been informative for you. And if you have any questions, feel free to reach out to us on the web at core-acc.com. We have a contact form. You're more than welcome to complete it and send it in. You can also contact me on Twitter, or you can go to LinkedIn and find both Doug and me and send us a question through LinkedIn if you like. We're always available. We love the opportunity to have a conversation. Anyway, this is John Coggle. I hope you have a great weekend, and I look forward to our next presentation with you.